we have little losses that happen. And if we made a claim on every single thing that cost us money that insurance could cover, we might get the axe from them. And so oftentimes we have to have an internal threshold of, am I going to make a claim on this? How many claims have I made this year? What have been the values of the claim?
Welcome to the Good Stewards Podcast, the only podcast dedicated to seasoned real estate investors who want to maximize the cash flow potential in their business. We are buy and hold investors with 1,000+ properties and markets across the U.S. who bring an insider's view into the nitty-gritty details of real estate investing. If you're looking to develop the mindset, teams, and systems that can dramatically build your real estate business and net worth, you're in the right place.
Welcome to this episode of the Good Stewards Podcast. I'm Ryan Dossie.
I'm Amanda Perkins.
I'm Bill Sirius.
And I'm Andrew Sirius.
There's lots of things that can go wrong at a property and with staff, but today we're going to get into insurance. Things that you need to know, experiences that we've had, and just kind of the ins and outs of something that doesn't seem like the most exciting thing. Sometimes can be a way to make a little bit of money or cost money. Before we dive in, we want to connect with you. Find us on thegoodstewards.com. If you like our content, feel free to share it on social media or just tell people about it. And don't forget to download our free ebook. I'm going to start with just kind of talking about different types of insurance and what's worked for us and kind of how we do things. When you're going... First of all, unless you are very wealthy and you can self-insure yourself, which means you probably own all your properties free and clear, insurance is 100% necessary. So don't forget to close out this step every time you make a property purchase. When you're first making a decision, insurance companies are going to have a lot of questions for you. They're going to know a lot of detail about the property, what kind of wiring is in it, what the construction material is. So it's good to have all that information. And what they're trying to figure out, first of all, is their risk on the property, and then also, what it's going to cost to replace it if you have a total loss, or what kind of repairs would cost. And if it has old plumbing and old wiring, it's going to cost you more to insure because things can happen to those properties easier and more expensive than newer properties. And they might ask you, and it might depend on who your loan is with, if you want an actual cash value insurance policy or replacement cost. And in our business, we do both. In our Oregon properties, our replacement cost is probably less than our actual cash value, meaning in most cases, we could rebuild the property for less than it would cost us to buy the property new, just because land is in there, that, the foundation is there. Just a lot of our appreciation in our market is not necessarily what the materials were used. In some of our other markets, we might have a $60,000 house that if it burned down, it would cost us $120,000 to rebuild it. But we only want to get $60,000 worth of insurance on it because we don't want to be paying double premiums to be covering ourselves. Or maybe you do want to do that. It depends on what you want for your business. Our insurance decisions are oftentimes based on what our lenders are requiring for us to have. So we kind of make those decisions accordingly.
I think that's super interesting, the piece with Oregon, because I think that's a good differentiator of if the property was totally lost. I remember when Bill was out in Indianapolis the first time, he's like, man, you couldn't build this for this cheap. And that's, the perks of buying vinyl villages at a discount in the Midwest. Whereas if you're in a market that's maybe a little bit more expensive or maybe a little bit more coastal, you may be into a property for more than it would cost you to build it. But it's also kind of one of those like, good luck finding this property and this piece of land to build this back on.
Right. So, yeah.
Remember, you're only insuring the building too. You're not insuring the land, and the building is probably 80% of the value, but that's different in different places. If it's San Francisco or Honolulu, and probably that's not the case. It might be 50-50, but you're just insuring the building. So insurance agent's going to look at the square footage primarily and say, what would it cost to rebuild this property? And that's the kind of standard that he or she's going to use when they're talking about how much the rate of insurance is going to be on that property.
I think if you have good insurance, and I've heard Bill say this several times, of as long as there's no loss of life, typically a major insurance claim can be a good thing, meaning it's something you may come out ahead on. I wanted to clarify. Amanda's intro said we're going to talk about how to make money off insurance. This is not like the mob in New York in the 80s.
I think they're still doing that. The mob hasn't changed their business plan much over time, from my understanding. I think also one thing to note is just a quick note is most banks will simply require that you have insurance. So if the option of self-insuring is only pretty much if you have no debt. And generally speaking, we would all recommend against that.
Well, where it gets tricky, and we've fallen into this hole a couple of times, is when you have a private lender that is loaning you the money on the front end of a purchase, there's nobody there looking over your shoulder requiring you to have an insurance binder at closing. So you can actually go through closing and forget to put insurance on a property, which we've done a few times to our chagrin. We have this massive checklist now that is, in big, bold print to remember to put insurance on the property. And we also, when we have a private lender, our lenders become additionally insured. But again, there's nobody looking over your shoulder to do it unless you remember to definitely put insurance on every property that you put under, that you close in escrow.
I don't know if I just have bad luck, but I feel like I have like one major insurance claim a year. In 2016, I had an actual arson at one of our properties. Somebody torched my house and 6 others on the same street one night. Fortunately, mine was empty. The following year, I had a flood. Tenant left open water lines on a second story of a house. And the neighbor, when he called us, was like, yeah, it's been leaking for like 3 days. Like, man, it would have been great if you would have called a little sooner. And then the last one we had was an electrical fire on a property that resulted in pretty much a total loss. So I think people can think, it's not going to happen to me, but I think it's one of those things that like, this isn't an area that you want to try to get creative or cut corners or skip
Well, and
on.
that kind of leads me to my next thing. You can shop around, but what we've worked, and you should, and especially when you're getting started. But one thing that we learned, and we learned the hard way, was insurance is actually a privilege and not a right. So you do not have a right for a company to provide insurance on your property. In fact, they can cancel you. So, in our experience in Oregon, we have a company and an agent that, we actually have a couple, because we have our top tier that we usually get the best rates, and they're the best coverage. We love working with them. But sometimes they're picky about the properties they'll insure. So we have another agent that works with, for another company that can find us those. Or sometimes we have to go and get really expensive insurance coverage to cover some of our older stuff, because, like our top tier insurance company has decided, it's just outside of their wheelhouse. We had an experience, I would say 8 years ago now, 7 years ago, maybe. And we had a relationship with somebody who was new to selling insurance. And he talked us into giving up our top tier insurance company that we really liked, which I'll just go ahead and say it was State Farm, because they provide the best, in our experience, they're the best rate and provide us the best coverage on our properties. And we moved over to another good insurance company. It was Farmers, and with an agent, and that he kind of talked us into. And I think we saved a little bit of money, but we should have never made the decision on the money piece. And then we had a pretty terrible thing happen at our property that was insured with previously been a State Farm insurance policy, moved to Farmers. And that year, we owned a lot of campus properties, and we actually had not a resident, but a friend of a resident climb up on the top of a 3-story building and fall off. And he did not survive. And it was terrible. And he was intoxicated when it happened. There were a lot of things about it, but we got our insurance policy canceled and State Farm wouldn't take us back. And we, just as a side note, we didn't end up paying out on the policy because we weren't responsible for the loss, but it was still something that happened at our property and can happen, especially, in a campus environment. And so we lost our farmers insurance, and we had sort of been grandfathered in with our State Farm coverage and just expected that State Farm would take us back. But the types of properties that we were having, like multifamily campus properties, that didn't fit in State Farm's wheelhouse. And we lost our grandfathered in privileges. And we ended up, having to go to, I would call it like a third tier insurance company.
Dollar General.
Wasn't Dollar General.
A lot less
but it was
insurance for a lot more money.
A lot less insurance for
down.
a lot more money is what it was. And it was, it was kind of one of those experiences. It was like, oh, whoa, okay. They don't have to just insure my property because I said, here's my property. Insurance companies are picky. Insurance is about weighing risks. And when they're looking at your property, they're making decisions on if they want your property in their portfolio. So it was something that, it was just one of those lessons that we learned along the way.
The family who unfortunately had to deal with that, did they attempt to go after you guys?
Not at all. But what happens with a death claim is that they have, I think it's normally 2 years to file a claim in the state of Oregon. And
it's actually 3.
If there's loss of life, it's 3 years. So we had that as like a potential mark against us when going, we have to report everything when we're going to get insurance. And that counted against us as a potential loss and potential, the reserve the insurance company was holding out for that was quite large because it could have been a cost. It would have cost a lot to defend ourselves. And then all of those things.
You learn things along the way that you never knew either. For instance, being in Oregon was helpful in that regard because a claim would have had to, going before a jury, would have had to have 51% that we were
liable
or somehow
responsible to the tune of 1% more than half. If this happened in Washington, if we would have been 23% shown by a jury, 63%, 18%, that's where the claim would have been. So the fact that we were in Oregon made it a lot less likely that we would be sued on it because it was not something that was at all going to get over 50%.
It wasn't even going to get to 1%. With that point, the problem was the fire escape went to the roof, and we actually requested to have the fire escape removed from the roof, and were denied.
Because the fire department has to use that to climb up to put a fire out.
But that roof is extremely... we can. This is a particular issue. Roof has an extreme pitch, and there's no way the fire department would use it. But they refused. They rejected our request to remove the part that went to the roof. So there's nothing we could have done.
I think the lesson is you don't know what you don't know, and you should not be cavalier about issues of insurance.
Also, it's helpful to sit down and talk to your insurance agent, but also sometimes they will fill your head with all of the, what if this happens? And what if this happens? And don't you want coverage for that? To where you can, you have to.
They're in sales.
You have to make your decision what's best for your company, and what that looks like outside of that. We have a commercial umbrella policy over the, to protect us from liability beyond our property insurance coverage, just things like that to try to protect ourselves in the event that there is a catastrophic insurance loss.
I think my takeaway from it, especially when you've got some seniority somewhere, is like the grass isn't always greener.
That's absolutely what it is. Yeah.
I think primarily if you have seniority, if you're brand new, look for good coverage at a good rate. But if you've been somewhere for a while, make sure you're prepared to commit.
And so, like in our like for our Oregon portfolio, it's a property by property basis decision. But I wanted Andrew to touch a little bit on what we've done in some of our other markets that makes it more, it is individual to the property, but also sort of a whole as a company, and how we put that together.
Yeah, because sometimes the grass is greener. And what we did in Kansas City, because we have a lot of properties out here, is, I mean, first of all, we were insuring on an individual basis, one by one, particularly with Affinity or REI Guard. And I have nothing bad to say about them. They are a good one-stop shop, very quick. You can get insurance just like that. They're not very picky. They're very good for investors. They're just in many markets.
And by the way, that not
expensive.
being picky can really come into handy if you've got a major rehab in front of you. And a lot of top tier insurance companies don't want to insure you if it's a vacant property, if it's got a lot of work to be done, if the electrical is halfway pulled out, they're not into that kind of thing. So other insurance companies are more open to it.
We also got some with Farm Bureau, which is interesting because they're state by state. So we found the Missouri one to be pretty good. The Kansas one, we weren't able to make any work. So that's an interesting thing. But eventually, once we got to a certain point, we realized, there's a high likelihood that a quantity discount is in store, and quantity discounts are a thing with insurance, just like they are with most things. And so we put our entire portfolio up to bid and went to basically 8 different insurers or something like that. And the one who ended up winning was an insurer who had been recommended to us from one of our colleagues, our friends, who I'll just give them a shout out, the Wooster Investments, who did a lot of apartments in Kansas City. And so we were able to get they had the best quote. It was substantially less than what we were paying. I think we were saved about 30% on cost and actually got a bit more insurance. The one thing, this kind of leads into so I mean, if you have a large portfolio, it is worth getting bidding them out on a quantity level, trying to get that quantity discount. This kind of leads into another discussion a little bit too, because one of the things you're going to be careful with, particularly when you're bidding out a portfolio, but even if you're doing a single one, is that you have them insured for a sufficient enough value to avoid coinsurance. Coinsurance basically is, usually it's, from my understanding, is if you're insured for less than 80% of the replacement value, coinsurance kicks in. And coinsurance is basically you are insuring the property with them, and they'll have, you'll have your payout, and then they'll split it depending on how far down you are. So if you have a property that's, replacement value is $250,000 and you insured it for $50,000, you get a claim for $10,000, you're going to get barely anything because they're going to split. You're co-insuring this property with them, and so you want to be very careful, particularly if you're looking to insure a large number of properties, or at least even a decent number of properties, that all of them are above that line for coinsurance. But that's something you need to take into account every time. And if you are going in a market where it's a little bit less expensive, you can't rebuild a property for the cost. You're going to be using ACV, actual cash value. You should ask them, make sure there's no co-insurance on this. That's something you just check with your insurance agent. They should be able to tell you. And so that is something definitely to be cognizant about.
Over the last 30 years, I've had a number of fires, a number of floods, all kinds of manner of grief with properties, including arson and other things. And again, as long as people are safe, I remember actually getting a call. I was in Ohio and back from Eugene, and it was a pretty substantial fire. And the first thing I thought was, everybody okay? And fortunately, everybody was. But what that presented was a real opportunity to go into the property and rehab it with insurance dollars. And by the way, when you get insurance dollars, you really want to have some company check into the insurer who's going to come out and figure out how much damage there is. But you might want to have ServPro or another company and even pay them a couple $100s to come out and do an evaluation, because you certainly don't want to undercut yourself when you're getting insurance dollars to build a property. So
get you some retail quotes.
well, yes. So you can do wholesale work, right?
Yeah,
In other words,
Angie's List is your friend here.
because you're probably going to be kind of the GC of it or oversee the GC of it. And, there is a profit margin built into everything, right? So get that retail quote and then use what we found is we've usually used every dollar, but we've really done a huge value add to the property. I remember taking a campus property that we were able to, it was a duplex. We were able to make one of them go from a 1-bedroom apartment to a 3-bedroom apartment. And the house, we also added a couple of bedrooms too. And in a campus rental market, that's just pure gold, because it's like you're adding units to the properity when you're adding bedrooms.
And not only that, this particular house was one of those that, it was older and we'd done an initial rehab, but it was tired and it needed a facelift. And we turned it into, I want to say overall, I think we more than doubled our rent potential on the property with the finished product from what we had started with. And I know we put some of our own money into it to get what we wanted out of it, but it's turned into a very valuable asset when it was performing, but now it's a superstar.
I would also touch on, just for anybody who hasn't filed an insurance claim like this, your insurance company really isn't in the business of just cutting a check. Their model really is to pay your claim and then see who they can sue to be made whole. I think that to me was pretty surprising on my first couple of like, wait a minute, like do you want to go after the guy who did this? So just kind of keep that in mind. We had a pretty good, pretty decent sub in St. Louis who was working on one of our projects, and the insurance company was an electrical fire, ended up deeming that they were somehow negligent through their, after fire inspection or whatever. And they actually ended up suing the GC to try to go after the GC's insurance to get made whole, this giant check they had to cut us. And unfortunately, that guy could no longer work for us. So just in case you don't know, that's typically how that works. So if a tenant in one instance with us flooded the property, they went after the tenant for like $64,000. Went after a sub on a different one. So that is how insurance recovers their losses.
Yeah, and oftentimes it's unlikely they're going to recover much of their losses, but they're a business.
They're going to try.
They're a business too, and they're basically trying to cover their bottom line when they have a loss.
One more caveat I'm going to interject in here is, when you're dealing with this, oftentimes, most of the time, there have been tenants in our properties during our losses, and they're going to be really unhappy, especially in the case of a fire or a flood, that their property was damaged and lost, and your insurance is not going to cover their stuff. And so we do always touch on people. We don't touch on it. We really, go into depth about get renter's insurance to cover your belongings, because our insurance covers our loss, but not yours. And they oftentimes are in one ear and out the other with that. And we don't require them to have that insurance, but it doesn't end. We, especially because I can't usually move back into their places. And so we terminate leases and immediately refund rent costs and security deposits to them, but we don't pay for their stuff, and they get a little salty about that. So you're going to have to deal with it. You better make sure it's in your rental agreement that you're not responsible for their stuff unless you caused the loss. And usually it's not our fault, unless you're just a very negligent landlord. Oftentimes it's just something happened. Losses happen.
That's the point of renter's insurance. That's what that actually covers. I think a lot of people think it covers like if they damage the property, but it's more to protect their property.
Yeah, and I know some property management companies require renter's insurance. Again, we don't. Higher end apartment complexes often require their residents to carry rental insurance, but it is, it's an extra step. It's something that not everybody wants or has the money for, and you just have to make that judgment call. There is something though called loss rents, and most insurance companies will have lost rents will be part of the cost of covering you in a fire or flood. And that means that for a certain amount of time that property is off market, that insurance company will pay you what you have been getting in rent. So you won't lose that rent. And that's a pretty important feature, particularly if you have a 6-month turnover or more in a loss, that you're going to get the rental. But make sure you do have lost rents as part of your insurance package on any particular property.
I do want to highlight Bill's timeline there of 6 months. Typically, when something like this happens, a fire, a flood, a major insurance claim, as the people who this is affecting, we can get pretty emotional and like, they got to move fast on this. I'm losing rent. I'm still paying mortgages. I still have taxes and stuff I have to pay. You need to kind of realize when something like this happens, take a deep breath or two. They're going to kind of take their sweet time in my experience. I don't know how long our flood in Indy took, but I think it was like 4-5 months. And then even then, like us getting the final like $12,000 check we were owed took another like 2 months. So it's kind of like, what did school teachers say? Like, your lack of planning is not my emergency or whatever. That's kind of how they handle it, of like, we're going to do this at our own speed and you can't really complain.
The other thing to consider is you also have an additional insured. If you have a loan on your property, and if you have a big loss, their name's going to come on the check from the insurance company. And what that means is you have to have them sign off on it in order for you to get the funds. And, we recently had one, and I reached out to our banker. It was a regional bank. He said, yeah, go ahead and send us the check. We'll hold it, and you can let us know when the repairs are done. And it was a big loss. And it was just like, well, wait a minute. We're still paying you. We want that money to do the repairs, so we had to negotiate it. But their policy was, yeah, you can have the insurance money after you do the repairs and prove to us that they're done. And then you have the money back. And that it wasn't a $5,000 loss in that case.
This is where you'll find a insurance company worth its weight kind of thing, is at this crunch period when you do have a loss. And I do have to give a shout out to State Farm Insurance. There are other great insurance companies. They're not the cheapest, but boy, I have gotten over 30 years such great customer care from them. And every time I've had a loss, including lawsuit issues, which, by the way, insurance covers as well, particularly if you're drawn into a lawsuit because somebody stepped on something that the step gave way or whatever, and they now have a bad ankle, whatever it might be. And I've had more serious than that kind of lawsuits that an insurer has stepped in and defended me on to the tune of thousands, tens of thousands of dollars, actually. And State Farm has never griped at all about it. And again, I'm sure there are other really good insurance companies out there. They're not the cheapest, but that's when you really learn you've got somebody on your side, is when there's a loss and they're facing the loss, but they're coming alongside you and said, we're going to take care of it.
I think you just used Nationwide's quote to endorse State Farm.
That can kind of lead into what, when you're with State Farm, we have little losses that happen. And if we made a claim on every single thing that cost us money that insurance could cover, we might get the axe from them. And so oftentimes we have to have an internal threshold of, am I going to make a claim on this? How many claims have I made this year? What have been the values of the claim? Because even though we are insured per property, as a company, they're valuing us. And so we don't want to make nuisance claims to them for $5,000 and risk not having the coverage that we like to have when we want it. So that's, we don't have a set limit ourselves of what we make our claims for, but we talk about it. Some things are really obvious. We're making a claim for this, but sometimes it's like we have a small flood after we had some freezing conditions or something, and it might cost us $10,000 and we have a $5,000 deductible. And we think we're not going to make a claim for this because we're going to go ahead and cover the cost of this because we made this claim here. And so we sort of make those decisions for ourselves as the.
Yeah, claims follow you too. So you can't just jump ship to another insurance company and say, well, I made a bunch of claims against the last one, but they won't know the difference. Yeah, they will.
It's called a loss history report. And a new insurance company is always going to want to see your loss history report. It's basically like your previous tenant record or your credit report for insurance companies. So they don't just go away.
And sometimes there's just not much, not much left after your deductible. And your deductible is one of the things you can raise your deductible. And we generally see insurance as being best for large expenses, and having a higher deductible is better. And so if you have a high deductible, if you have a $5,000 deductible and it's a $6,500 claim, you're getting $1,500 is even worth it. Like, this can be true with roofs too. I mean, if you have a low deductible, you might be able to get, have a hailstorm and get your roof replaced. We have a higher deductible. So basically, if it's a house, the deductible is basically the cost of a roof, generally speaking. And so there's no point. If it's a commercial building, an apartment, okay, there might be a point. But so taking into account your deductible when deciding whether or not to file a claim is something to do. And also taking into account when trying to bid down your rate. If you feel like your rate is too high, you can increase your deductible. And as long as you have some cash on hand to cover those expenses if they hit you, you will probably save money in the long run.
It's like the poor man's
insurers are in the
self-insurance.
business. Yeah, insurers are in business to make money. So the less you do, you will generally pay them more than they pay.
Yeah, they're in the business of not. You paid them $1,000 for the year for a property and they cut a $50,000 check. You can't go broke making a profit, but you can go broke paying claims like that.
Absolutely. And the next year you won't have that insurance. So, in closing, we'll go ahead and wrap up. We just want to kind of share a little bit of our experiences and talk about the necessity of insurance and different types. We really recommend finding somebody that you trust and will educate you. Insurance is constantly an education process. So, it's good to have somebody on your side, somebody that you trust, not just some slick salesman telling you what you want to hear when, he's not going to be there to hold your hand. When the loss comes, in our case, our insurance agent does. So we really appreciate that.
There was State Farm, by the way. State Farm is on your side.
Thank you for tuning into this episode, and make sure to look us up, thegoodstewards.com, and make comments, suggestions, reach out to us. We like to hear from you. Helps us know what you like, give us some good content. Thanks for joining.